Welcome back, traders. So this is the second video in mapping the trend line bounce with confluences. So trend line mentioned already can bounce, it can break, or we can have the counter trend line. Now this information is vital to know about, especially if you're studying technical analysis. However, remember, it's something that you're going to have to look for every single day in the market. It's just the overall picture to assist us. So trend line bounce, there are certain rules and certain things we're looking for. I keep this video quite straight and sweet, to be honest. But if I can just pull up the book, okay, so trend line application. Now, trend lines, yes, they can be used on other markets as well, such as gold, such as oil, okay? Same concepts, same price action. If we look at this image over here, okay, I've gone through this in video 1. When applying a trend line, there needs to be just 2 points. When we are using the first point at the level of support, which is significant low in this case, always use the wicks, remember, again in the book, so you can study these videos alongside the book. That's what the course is all about. Again, using the crispy charts that we have. Quite recommended to get a MacBook as well. I'm not sure if I said this in other videos, but just the Retina display on the Mac brings it all to life. It just makes it so much more enjoyable. So this is the actual trend line, which is in the book there on USD CAD. Okay, so on 0.1, just double check that. Yeah, so 0.1 to 0.2, and then we have 0.3 as the third bounce going that into a minute. So obviously, you click the trend line, you drag and place the trend line directly at the second point. You cannot place the trend line on this point if there's just one candlestick there. We have to actually see there has been a leg, okay, an uprise in this case. And what I mean by that is if you go to page 99, you can see here this is a no-no. This is incorrect. So you can't just take a trend line from one point and drag it over to current price or where you see just one candlestick formation occurring, because guys, we need to actually see a leg be formed, okay? The market needs to actually pull up in this case. Why? So it confirms it is a rounded bottom, not just one candlestick reversal, because that candlestick reversal, remember, they are not 100%, they're 80%, 75, 80, 85%. And they, the next candlestick after you found, let's say, a bullish engulfing or even the 3-pin pattern here, it could just break straight through. So it's not a significant low in that case, in the case of making a rounded bottom. So over here we have 0.1, 0.2, because boom, up move afterwards. 0.1 to 0.2, again, up move afterwards. That's a 3-pin formation there as well, if you focus on the wicks. 0.1 to 0.2, no go. No go. So just practicing the trend lines correctly. So even on page 98 over here, we have the inner and outer. So we have 0.1 gone from 0.2, which is the direct lower high. Then from 0.1 to 0.2, the next direct lower high. I haven't cut straight through. Go from 1 to the next lower high, 1 to the next lower high when drawing your trend lines. It's that simple. So here, as you can see, with 0.1, boom, I've got straight through the lower high, bearish engulfing formation. And I've just put it onto the next one. No, you're going to get incorrect entries, incorrect break points, incorrect bounce points. Okay, so that's that there. Now let's just go back to this. So USD CAD, as you can see here, we had 0.1, 0.2 right on the wick there. And then there is our 0.3. Now 0.3, this all comes nicely in tandem with the key levels as such. I forgot to mention on the last video as well, guys. I'm really sorry about that. With the key levels, just to top the key levels off, you may want to just take a notepad out for this. Now, when a monthly level is broken, okay, and we hold above a monthly key level, whether it be resistance or whether it be support, there is, okay, a 75% chance the next weekly level will be met upon a break of a monthly or monthly support, resistance or monthly support. So for instance, if we held above this, okay, we're strong above this, we're looking at the next weekly. We didn't do it here. Why? Because that was a weekly rejection. This is the daily time frame, remember. So again, if we get a weekly break above or below a monthly area of support or resistance, there's a 75% chance the next weekly level will be met. And then this is great for finding our targets. Okay, I just needed to drop that in there. And also, which I didn't drop in as well, very, very sorry, on the last video, is that there is a 75% chance. Okay, I'm just going to maybe draw this over here. Okay, 75% chance that the market will form a new higher high, okay, after a confirmed higher low, and then vice versa, 75% chance the market form a new lower low after lower high. So if you've got these rules down, for instance, let's say you've seen a lower swing high potentially form just around here. Let's say it's a 3-pin, or it could be a bullet bearish engulfing, or it could be a shooting star, or it could be an evening star. It could be any kind of reversal formation in alignment with, let's say, a key level of resistance. Okay, the 75% chance that the market will form a new lower low after a confirmed lower high. So if this is a confirmed lower high anywhere around here, again at resistance, and you've confirmed it by knowing your candlesticks, again candlesticks are going to come in very, very handy. We're looking at this level across here, okay, because remember, this is why it's handy to just mark on our last lower highs, lower lows. Okay, there's a 75% chance the market will form a new lower low after a confirmed lower high. So more or less, you're looking at this as target confluence, and this is vice versa, okay, for the top one. So lower low, lower high, lower low, lower high, lower low. So spotting these early and spotting price action indications, we can see, okay, potential for a new lower low. And if I can relate this over on the Aussie, so we're already on the Aussie. If we relate this to, let's say, the 4-hour time frame over here, if I can just remove some of this mess. If I relate this, what is this here? This is a lower high, isn't it? 3 pins, 1, 2, 3. Also, we have a hanging man. That's a hanging man candlestick. So what's expected? We are expected to make 75% chance to make a new lower low. Not all the way down to 7,400, but we're just expected to make, and the market will do this very, very precisely, a new lower low past the wick of the last lower low. And then it might pull back and then might go for it. Okay, so they're the rules that I just wanted to throw out. I forgot to put them in the last video, so apologies for that. So there it is. You maybe take a screenshot, write it down, and it's vice versa for the higher highs and higher lows. So we can use this for this rule in particular, and just knowing about this and using this in combination with all of your analysis, people forget about this because they get too mixed up in all the indicators and all of the other crap that doesn't work. Okay, so this is all just pure price action, guys. I'll come back to that. So let me go back to the USD CAD. What made me think of all of that is obviously because the example in the book, we didn't make a new high then. So can you see here we have the higher low. a higher high was expected, but it didn't pass the peak, okay, at the time of this screenshot. This was November 2015, I believe, when I did this screenshot, or December. And as you can see, we're around here. So if I take that rule into consideration, so the higher high there, we have the higher low here, okay, higher low, and then boom. This area as well, guys, was also a key area of monthly resistance. And it actually went to the next weekly level with ease, which was around here somewhere. Okay, so we had the different rules going on. We had the higher low, which was, we knew 75% chance it had to make a new higher high, which it did. But as it made the new higher high, it broke through the monthly resistance and it boom, went all the way up, 75% chance to the weekly. So putting these different rules into perspective and taking them into consideration will greatly assist you with all of your trading and analytical needs. Okay, so that was that. So over here, the third bounce is the strike zone to go long in this bullish example. So I'm just going to zoom down into the book and just pull up what we're actually looking for. Again, there's some vital information in the book too. This is the page I'm after. So what we're looking for when the market comes back for its third bounce, it's going to be the same pattern over and over again. So first, these are the confluences. We have 5. 1 is the trend line acting as support. So yes, we have it as support there. Yes, we have it as support here, remember? So that's the support zone. Number 2, we're looking for any candlestick formations at the trend line support. Now remember, these trend lines are going to be drawn on the weekly and then the daily. We can do it on the 4 hour as well, yes, but we can come to that later on, or if you go through the charts yourself, you will find this. Again, same thing, where you can maybe find the third bounce. Even on the Aussie, actually, if I go to 4 hour time frame on AUD USD, I think it was like a week or 2 ago, we had, was it from that peak, or was it from this peak? It's from one of the peaks anyway, I believe. No, I don't think it was. Oh, something I was looking for. Okay, so 0.1, 0.2, potential for 0.3, and then drop. And it still could be a potential because, again, guys, if this does manage to pop up to that level, guess what? It will be a lower high, won't it? Even if it does manage to reverse from here. So another, let's say, 80 pips or so. If Aussie does manage to come all the way up to this point, we have 0.1, 0.2, 0.3, lower high, ready to come down and potentially, boom, make new lows. So what I'm going through now, sorry to get distracted with the Aussie, are just the things that we're looking for around that third touch. So any candlestick formations at the trendline support. So with the USD CAD, we had a 3-pin pattern, 1, 2, 3, if you can see that there. 3 pins, wicks, 1 wick, 2 wick, 3 wick. And we can just consider these two alone, 1, 2, as a bullish engulfing. That's just scraping, bullish engulfing, 75–80% of the body right there. Okay, so that's that. We could enter directly from those. Stop loss placement will go. This only goes for the daily and the 4 hour, not the weekly. So you map out the lows there, which would be around there, and the stop loss in this scenario would go. Same with any when you're trading from any of your other candlestick formations, 15 to 30 pips below there. Okay, just that. And again, in this case, obviously we have other confluences to look for, like the counter trend line break, which would be this. We can use these counter trend lines, countering the overall trend, but we're waiting for a breakout, which would be this candle here. Get to that soon. Number 4 would be moving average crossover. Okay, the MAs in the book and the moving average theory, we're going to get a crossover before a breakout of a trend line. We can get a crossover at the same time as a breakout or just after. So we always want to use the candlestick break and the moving average crossover in alignment with each other for the highest confluence. Then we have Fibonacci retracement like A, B, C, D, okay, which we'll get to in the next section. And I do believe we had that here as well on the USD CAD. Let me just throw it up there. So we had A, B, C retracement around the 38 and 50, and then extension target 1 was hit, and even 2 as well there. Okay, I'll get to that shortly. So they were the confluences. Bullish overall, nice pullback on USD CAD. We have the bullish engulfing 3-pin pattern. In terms of a counter trend line, the only real one we could have placed on there was either that one, very, very steep. Okay, and the break would have been there. And with this as well, if you put your trend lines on the weekly, you can always step down to the daily to see if you can refine that. If you plot your trend lines on the daily, we can step down to the 4-hour to see if we can refine the entry. Like this over here. So you spot obviously the candlesticks and so on the daily. You say, okay, it's got a potential to rise now. Let's see if I can go down to the 4-hour time frame to see if I can refine this. So that will be a refined point there. So what we can see is obviously all of this is in the midst of the bullish engulfing and the 3-pin formation. It's the third bounce of the trend line. Here we have the crossover. Got the crossover just there. And there's your breakout. So you could have just waited for the breakout and your breakout entry, which would have been at the top end of this candle. Boom. Buy. Stop loss still goes 15 to 30 pips below, and then you just hold in this trade. Just holding this trade, you might find more counter trend line moves, such as this one, which you could again add positions if you wish. Okay, crossover, breakout. So what our aim is here is to get the overall trend direction, even if you're not trading from the trend line. Okay, just knowing the rules and being aware of the rules is fine, because we can use other strategies, daily highs, daily lows, not previous day highs, previous day lows, and we can then zoom down to other time frames and buy. Okay, so this kind of puts us in favor of 80% buy trades overall. So they're the confluences we look for. I do believe on the Euro USD, which I plotted on earlier on. Okay, so here, 1, 2, 3, we had a pin there as well, but what, we didn't make new highs. Why? Because Euro USD, we always have to look at the bigger picture, the monthlies, the weeklies. That's what the key levels help us with. Just to be vigilant of what's above us. So 1.1450 is a key level of monthly resistance on the euro. So for that to make a new high after this pin here would have been quite something. Again, you could maybe use the counter trend line there. You would have got a break, false break, not a very good close. The moving averages did cross over. This would have been a losing trade if you took this off the daily alone. But look, we have a key area of resistance right here, which is a monthly area. So obviously it would have a zone on there as well. So you're not going to trade right into the zone. You would rather wait until the zone's broken. Okay, then think about maybe going long. Okay. So we have the back end retest of the trend line now. Going to into the modalities of trend line break and the rules behind the trend line break. So we kind of went from bullish to bearish in quite a fast paced manner. So examples, always looking for the third bounce, that's all. The fourth one is going to be more or less 50-50. It's a little bit risky. I wouldn't really bother with that, guys, but that's what to look for. If I spot any of this on the weekly breakdowns, again, I'm going to try to help everybody in the member zone as much as possible. But that's the rules. They're the confluences to look for. You can skim over the book. As you can see, there's a couple more examples in the book. That's a similar one. I know that's a 4-hour chart. That's similar to the one I've just marked out on the Aussie. So you get the ascending, so an upward slanting bullish or ascending trend line. That's ascending. Downward slanting bearish is descending. So ascending and descending. So just get used to the terminology as well. So I'm going to go on to the next video, and I hope that helped. That was a successful piece on the USD CAD as well. I'm sure you guys have already noticed. But I hope you took the rules into consideration of the higher highs and higher lows, lower highs, lower lows, and also what happens when a monthly area of resistance or support breaks. So that's that. Thank you.